We need to talk about how funding has changed in 2024 is because I've got a lot of founders that I'm meeting on a daily basis that come in and they have a mindset that it's still 2021. Those days are over. There's a new normal. We are not going back to 2021, and there's a good reason for it, which I'll explain to you in just a moment. Before we continue, I want to qualify myself here. I'm a 7-time funded founder with 2 exits. I had my heyday during Web 1.0, and then I sold my second company in 2017. It's been a while, but I've stayed on top of all the trends. I talk to investors every single day, and they're giving me new information. I also talk to a lot of founders who are telling me their stories, what they had to deal with, and things are completely changing. For example, in 2021, when I used to see checks being written and get into the bank in 4 weeks, now we're waiting 6 to 9 months. I talked to an investor just at the beginning of this week, and they grilled me. Everything seemed positive, and everything's at a standstill because they can afford to wait and take their time. That's what the market's doing. What's happening is that there's a big movement into startups that are pedigree, meaning there's a flight to quality. We're talking about startups that are much further along, and they're the ones that are getting the funding right now. And if they're successful, that pattern is going to continue. Yes, the market will get frothier and frothier, and yes, there will be money sitting on the sidelines, and people will start to get a little anxious. There'll be FOMO on the investor's part, and they'll start allocating to a little bit riskier ventures, but there's going to be a new standard of all the deals, and as soon as Y Combinator, A16Z, Sequoia, all these other companies start showing the results of investing in companies that have been waiting a little longer, showing more traction, revenue, have working products, product market fit is already in place, everybody's going to want to invest in that type of startup. And early stage founders are going to have to find investors in the long tail, in those little sneaky places, because again, the standards are being reset. So here's the mindset that I want you to put yourself in. Everything you learned about startup funding up until this time, you need to just put it out of your mind and say the rules have changed, because it's lagging. There are lagging indicators. You're reading news about startups that are getting funded, and you go to TechCrunch and you can see the funding rounds happen in 2021, but now you're seeing those companies file for bankruptcy. They are leaving the scene. They are exiting stage left because they were funded during really good times and they didn't have the same environment to contend with. And if you're raising funds and it takes you a lot longer, you're going to be more disciplined with your capital, but that mindset has to change. Everything is going to take twice as long and cost twice as much in terms of time, the money to establish your MVPs, the equity that you're going to give up just to get your project up and going or get your venture to the point where it is fundable. Everything's going to take twice as long and twice as much money. And there are 2 things that you want to be thinking and reminding yourself. This is what I teach to my founders all the time. Be relentlessly resourceful, stole that from Y Combinator, by the way, and pessimistically persistent, meaning that it doesn't matter if an investor gives you all the good signals and say, we're going to send you the LOI, it's coming, don't worry about it, the check's in the mail. You want to be a pessimist and act like it's not going to happen until that check is deposited, clears, and is in your bank account, and you can start drawing against it. I know founders that were promised large chunk of money, like $12 million, and they were given the first half $6 million and told to do all this stuff with the capital, move to another location, and then start a big factory and start spending all that money because the next $6 million is coming. And guess what? That $6 million did not come. And now the founder is sitting there going, what did I do all that for? This is not a good situation to be in. Everything has changed. So be relentlessly resourceful and pessimistically persistent. Relentlessly resourceful, leave no stone unturned. Keep plugging away, keep grinding, make those phone calls. Find out if you can get conversations with investors and ask their advice and ask them to refer you to other investors. And pessimistically persistent, act like nothing is set in stone, nothing is a done deal until it is a done deal, and you keep being relentlessly resourceful by the time you get there. Don't be a negative person and be down on yourself the whole time, but you want to have a very measured and realistic view of what things are going to take. If you're sitting there and you need funding and you only have 3 months of runway, you're in survival mode. Be relentlessly resourceful and start grinding away and do what you need to just to survive and extend that runway. Whether you have to go drive an Uber or you have to do personal things, get out there and do it. You should be thinking strategically when you have 12 months of runway. But first, you got to get those checks in the bank, and you got to make sure you have the runway to begin with. The other thing is, if you're looking at the different funding rounds, it was the factory assembly line way back in 2021 and the years before. You went and got pre-seed, you found it somewhere, you got seed. And the whole purpose of seed was to spend it and grow so they could sell you into the A round. And with your A round, you find product market fit, and then you go B, C, D, and then you go public or you get acquired. That was the factory model, and pretty much all investment was about managing the portfolio. It was all about just getting it down the assembly line, and investors would tell you to light the capital on fire. 20 cents of every dollar that comes in needs to go to growth, Google AdWords and Facebook ads and all the paid traffic that you can possibly get because you want those growth metrics, and then you're going to turn on revenue. That's the mindset that happened back then. It's no longer. Today, investors want to see that you've legitimately built something and that it is making money and you are using your capital like it's the last funding round. If you are in a pre-seed spot and you're trying to raise money, you need to be thinking like a seed company. That's the inflection point. So if you're in pre-seed, you want to get to the point where you can get a seed round, and you're not going to get funded until then. Gone are the days where people would just give you capital, the institutional money anyway, just to figure things out and to build a prototype or an MVP. That's not going to happen anymore. If you're not generating revenue and revenue that reflects a seed round, you're not going to get pre-seed, and keep going. If you are at seed round and you want to raise money like a seed company, you need to be at the A stage. You need to have metrics that reflect an A round. Before, what got you an A round is not going to be that anymore. We're going to keep going. It's a B round now. You see how everything is moving one stage later. If you are at seed, act like you want to get to an A level in terms of your metrics, then start raising once you hit that inflection point. That means revenue, your MVP is out there, you're starting to show signs of product market fit, and believe me, if you can do that, then you are going to have investors knocking down your door. Let the investors come to you. But until then, get yourself in the right mindset. Relentlessly resourceful, pessimistically persistent, and keep working away, and just assume that you're not going to get funded, and if you are, it's going to take twice as long and twice as much money to get there. That's a mindset you want to be in. The days of easy money are over, and unfortunately, I see a lot of founders that have gotten into the mindset and it hasn't done them any favors. I'm not going to say that founders are lazy, but founders are a little entitled and start acting like funding should be easy, and then they get incensed when it doesn't happen. They get mad at me as the advisor and say, investors aren't contacting me. I heard that you could get me all these investors. Maybe in 2021, I could pick up the phone and get you a few meetings, but today I get the same questions. How much revenue are they making? What stage are they at? What are their growth metrics? Are they on the path to profitability? What do you think about those things? And I have to look the founders in the eye and have that realistic conversation to figure out how we're going to get them there. It doesn't mean you can't raise funds. You might be able to raise a pre-seed round with a very, very generous angel that comes through friends, family, and associates. I will help you with that. I'll help you with your pitch decks. I'll help you get everything lined up, but I'm going to be more focused on what are you building? How are you getting that traction? And how can we get you to the point where investors are contacting you because you got buzz going on and you're in the best spot, if you can be, get here, that you don't need investment. Best time to raise investment is when you don't need it, and you say to the investor, yeah, you know what? Pitch me, because I don't need the money right now. We're going to be fine. We're going to build a solid business with sustainable revenue. And if I need your money, it's going to be for growth. If I even want to grow, I could be happy just building this to a $5-10 million company. Get the investors pitching you by building a great company first. And if you do that, trust me, your valuations are going to be better. You're going to have more equity so you can be richer in the long run versus these horror stories where a company raises $300 million and the founder works in there for 10, 15 years only to break even, make $150,000 a year, and just hope that everybody breaks even. These horror stories exist, and they're becoming more and more rampant as we're getting into this mass exodus. There was an extinction event in 2023 where 3,200 startups that we know of went away, wiping out approximately $246 billion of funding. And all these companies that were waiting for their A, B, C, D, E rounds, building companies like it was back in 2021, those are going to go away, and you're going to see this mass wave of shutdowns. Mark my words, I'm recording this right now, and you're going to see this start to happen. It already is happening. I don't need a crystal ball to tell you. It's just common sense financial principles of what happens in startups. So finally, put yourself in the right mindset. Let me know what you think. Give me your comments, and we're going to have some serious, straightforward, in-your-face conversations, because as an advisor, I want to help you get to that other side. Let's do it together. Thanks for hanging out with me on this video. Like, comment, subscribe. It's always helpful. I'll see you in the next video.